You know, when I pick up my phone, I'm usually just thinking about the app I'm opening.
Right, the task at hand.
Exactly, or the message I'm sending.
Yeah.
I almost never stop and think about the sheer scale of the connectivity making it all happen.
Yeah.
We just take it for granted.
Oh, completely. And for a company like Qualcomm, that's been the story for, what, 15 years? If you had a smartphone, you were their customer, whether you knew it or not.
Right. But then a document like this one lands on your desk.
Hmm.
This is their fiscal Q1 2026 earnings report. It came out yesterday, February 4th. And you realize chip inside the phone is just, it's a wildly inadequate description now.
It really is. We're talking about a company that's rewiring cars, running factories, and basically building the physical backbone for this AI revolution we're all living through.
And this report, it's not just numbers. We have the investor commentary, the CEO's quotes. It's like a roadmap for where tech is actually heading.
Yeah, and it's a complicated map. You've got these record-breaking profits on one hand, and then these really specific, frustrating problems on the other.
It's a real pivot, isn't it? Like a legacy giant trying to shift into AI and automotive while still, paying the bills with phones.
In a market that's less than ideal.
So that's our mission for this deep dive. Let's unpack that pivot, figure out what on earth physical AI actually means, and why a company making record money is also talking about a supply chain crisis.
Let's do it.
Okay, so let's start with the big headline numbers, because they're staggering.
They are.
Record revenues of $12.3 billion for the quarter.
Just for the quarter.
It's a 5% increase year over year. Now, for anyone listening, 5% might not sound like a lot. Is that actually impressive for a company this big?
Oh, it's absolutely impressive in this context. Look, this isn't some software startup that can double its user base overnight. This is a mature hardware company.
Right.
Moving the needle by 5% on a base of $12 billion is a massive lift. It tells you they're finding ways to get more value out of a market everyone thought was saturated.
And it's not just sales. They're keeping more of the money. I was looking at the profitability, the earnings per share, or EPS.
Yep. This is what Wall Street really cares about.
The non-GAAP EPS hit $3.50, which is up 3%. The GAAP number was $2.78. Okay, can we do a quick sidebar? Why are there two numbers, and why do we focus on the non-GAAP one?
Sure. So GAAP is the official strict accounting number. It includes everything: stock compensation for employees, costs from acquisitions, all of that.
The legally required number.
Exactly. But investors often prefer non-GAAP because it strips out those one-time or irregular costs. It's a cleaner look at the actual operating health of the business. It answers the question, is the core machine making money?
So the core machine is making $3.50 a share.
Right. And in early 2026, after months of hearing about economic headwinds in tech, that's a really strong signal. It shows a resilience the market wasn't fully expecting.
Their CEO, Cristiano Amon, seems to think that resilience comes from one place. He used this phrase, I had to circle it. He said momentum is growing across personal, industrial, and physical AI.
Ah, physical AI.
It sounds like robots. It sounds like something out of a sci-fi movie. But what does that actually mean for a business?
It's a really important distinction. See, for the last couple of years, AI has been mostly digital, right? Chatbots, image generators,
Right.
things that live in the cloud.
Software.
Right. Physical AI is what happens when that intelligence leaves the data center and goes out into the real world. It's not just a chatbot writing an email.
It's a chip in a car hitting the brakes.
Exactly. It's a sensor on a factory arm that feels that a part is fragile and adjusts its grip. It's AI with real physical consequences.
So it's AI that touches grass, as they say.
AI that touches grass, asphalt, and steel. And for a chip maker, that's where the money is. Because that processing has to happen on the device, not in the cloud. You can't have latency when a car needs to brake.
Which brings us back to their main business, or what we thought was their main business, QCT.
Qualcomm CDMA Technologies, yep, the engine room.
And that engine room pulled in $10.6 billion. But even with all this talk about cars and factories, handsets phones still made up $7.82 billion of that.
The smartphone is still king. It's the cash cow that funds all the new adventures.
But this is where the report gets a little tense. The revenue is up. Premium phone demand is high. But then they say the near-term handsets outlook is impacted by industry-wide memory supply constraints.
And that is the plot twist of the quarter.
So what does that mean? Are they saying they can't get their own processors? I thought they made the chips.
No, that's the crazy part. They have the processors. The Snapdragon chips are ready to go. The bottleneck is the high-performance memory, the DRAM and NAND that goes alongside it.
The storage.
The storage and the working memory. Think about it. We want our phones to run these huge AI models locally now, right?
Yeah. AI on device is the big marketing push.
Well, those AI models are memory hogs. They need huge amounts of super fast memory to work. So the amount of RAM in a high-end phone has just skyrocketed.
Ah, okay. So a phone that used to be fine with 8 gigs now needs 16, maybe 24 to run the cool new features.
Precisely. And the companies that make those memory chips just can't scale production fast enough to meet that new higher demand. So Qualcomm has the brain, but the phone makers can't get the rest of the nervous system to build the phone.
That has to be infuriating. You have the product, you have the customer, but you can't ship because a different company has a bottleneck.
It's a classic supply side problem, not a demand problem. The appetite for the phones is there. The ecosystem just can't keep up.
It really shows you how interconnected and, I guess, fragile this whole tech supply chain is.
It's a delicate dance. And right now, someone's stepping on someone else's toes.
Okay, so while the phone business deals with that headache, there's another part of the company that seems to be doing great. The growth engines.
Automotive and IoT.
Automotive revenue is up 15% to $1.1 billion. Now, a billion is obviously a lot of money, but it's still way smaller than the $7 billion from phones. Why is this so important?
It's about the quality of that revenue. This is the second quarter in a row they've cleared $1 billion in auto. It proves it's not a fluke. But even more important is that automotive revenue is sticky.
What do you mean by sticky?
Well, you change your phone every 2, maybe 3 years. The market is incredibly fast-moving.
Sure.
But a car, you keep that for, what, 7, 10 years? And
Yeah.
car makers design them on these long 5 to 7-year cycles. Once Qualcomm gets their Snapdragon digital chassis designed into, say, a new GM or BMW platform,
They're locked in for the life of that model.
for a decade, maybe more, it's predictable long-term revenue. It's much safer than the chaos of the handset market.
So they're building a slower but much steadier river of cash.
A very wide river, because it's not just the dashboard screen anymore. It's connectivity, driver assistance, all of it.
And you add that to the IoT, the Internet of Things business, which is also up 9% to almost $1.7 billion.
Right.
If you just do some quick math on that, auto and IoT together, that's nearly $2.8 billion.
Yeah.
That's a huge business that has nothing to do with whether someone buys the latest flagship phone this year.
It's the proof. The diversification plan is working. If the phone market stagnated tomorrow, they'd still have a nearly $12 billion a year business just from cars and connected gadgets. They did not have that safety net 5 years ago.
It really feels like they're building a whole new company inside the old one.
That's a perfect way to put it. And they're making some interesting moves to support that new company. Did you see the acquisition they mentioned?
I did. Alphawave Semi.
Yeah.
I'll be honest, this one confused me. Qualcomm is the edge company, right? They live on battery-powered devices. But this acquisition is to help them expand into
Yeah.
data centers.
Yes.
I mean, why would you want to walk into that fight? You've got NVIDIA and AMD in there. It feels like a suicide mission to take them on directly.
It does look like that. Why poke the bear, right? But if you look at what Alphawave actually does, they aren't trying to build a better GPU to train AI. They do high-speed connectivity.
They're building the plumbing.
Exactly, the plumbing. As these AI models get bigger, the bottleneck isn't just the chip speed, it's how fast the chips can talk to each other. Alphawave is a leader in that specific kind of plumbing.
So they're not replacing the brain, they're upgrading the nervous system.
Perfect analogy. And there's another angle. Power consumption. Data centers use an insane amount of electricity. Qualcomm's entire history is built on power efficiency for phones. They're betting they can bring that expertise to the data center.
So the sales pitch is, we won't replace your NVIDIA chips, but we'll connect them faster and cut your power bill.
That's the wedge. It's not about beating them at their own game, it's about changing the rules. They want to be there when the AI is created in the cloud and when it's used on the edge.
That makes a lot more sense.
Huh.
Okay, speaking of new identities, I have to ask you about the branding thing I saw in the About Us section.
Oh, I know what's coming.
We all know Snapdragon. It's a cool name, it's fast, it's on soccer jerseys. But now, for their industrial business, they've introduced Qualcomm Dragonwing.
Dragonwing!
It sounds like an item from a video game.
I equip the Dragon Wing shield.
It does have a certain fantasy novel vibe to it. But, you know, names aside, strategy is actually really smart.
How so?
Think about the audience. If you're selling a factory automation system to, I don't know, a Ford plant manager, you can't walk in and say, trust your safety systems to Snapdragon.
The chip that powers your kid's phone can now run your 1,000-ton press.
Yeah, I see the problem.
It doesn't track. Snapdragon means consumer. It means fun. They needed a serious business-to-business brand. Dragon Wing is for products that empower businesses and industries. It draws a clear line in the sand.
So Snapdragon's for your pocket, Dragon Wing is for the factory floor.
That's it. It tells the market and their own salespeople that this industrial side is a serious, distinct business.
I just hope the logo's cool.
I'm sure they spent a few dollars on it.
Speaking of dollars, let's talk about the cash flow, because this is where investors get really happy. For all the complexity, this company prints money.
An incredible amount. They returned $3.6 billion to stockholders in 1 quarter.
How did they do that? What's the breakdown?
So about $949 million was paid out in dividends. That's the direct cash payment to shareholders. But the really big number was the $2.6 billion they spent on stock buybacks. They bought 15 million of their own shares off the market.
Okay, for anyone listening who isn't a trader, why does a company spend billions buying its own stock back? Is it just a way to boost the price?
That is a side effect, yes. Fewer shares means higher earnings per share. But the real reason is it's a massive signal of confidence from management.
How so?
Look, the leadership team knows the company's real situation better than anyone. They know what's coming. If they were worried about the future, they would be hoarding that cash for a rainy day.
Right. You don't spend your emergency fund if you think you might lose your job.
Exactly. Spending $2.6 billion on your own stock is management screaming, "We think our stock is cheap right now. We believe investing in ourselves is the best use of this capital." It's a huge vote of confidence.
Okay, so they're making money, sharing it, growing new businesses. It seems great.
Yeah.
But we have to talk about the guidance for the next quarter, the reality check.
Right. The road ahead.
They're projecting revenue for Q2 between $10.2 billion and $11.0 billion.
Which is still a very strong number. But you have to read the fine print. That guidance explicitly includes the estimated impact of memory supply constraints.
There it is again, the villain of the story.
It really is. They're basically telling Wall Street, this number is lower than it should be. We could sell more, but we physically can't because we're waiting on parts from other people.
So it's capping their potential.
It is. And it creates uncertainty, which investors hate. Is this a one-quarter problem, or does this memory shortage drag on for all of 2026? Nobody knows.
And what are the other big risks? The forward-looking statement section is always a fun read.
Well, the usual suspects are there, but they're very real. Concentration in China is a big one. So much of their revenue is tied to Chinese phone makers.
And with the current geopolitical climate,
It's a tightrope. Any new trade regulation or export ban from either side puts them directly in the crossfire.
and then there's the risk of their own customers becoming competitors.
Yes, the vertical integration threat. The fear that a huge customer will decide to just design their own chips in-house.
We've seen Apple do it.
We have. So Qualcomm is in a constant race to innovate, to make their chips so much better and more efficient that it's just not worth it for customers to try and do it themselves. They have to stay essential.
That sounds like a stressful way to run a business.
Probably keeps them on their toes.
So let's bring it all together. What's the final verdict on Qualcomm in early 2026?
I think the verdict is that they're successfully navigating a minefield. The phone business is the steady cash cow, even with the supply issues. But the real story is that the big pivot is actually working.
The plan is paying off.
It is. Automotive is a real billion-dollar business now. IoT is growing. They're making a smart play for the data center. They're becoming less of a simple component supplier and more of a true platform company.
Not just a part in the device, but the foundation of the whole intelligent system.
Exactly.
And for you listening, I think the big takeaway is how this changes our view of AI. We get so focused on the software, the chatbots. This report is a huge reminder that AI is driving a massive boom in hardware.
It's so true. AI isn't just an algorithm floating in the cloud. It needs silicon, it needs power, it needs memory to run, and that hardware is going into our cars, into our factories.
Which really makes you wonder, what's the defining device of this decade going to be?
That's the billion-dollar question, isn't it?
I mean, if the smartphone defined the 2010s with this physical AI and Dragon Wing push, is the defining device of the late 2020s going to be the car you drive or the factory that built that car?
I think Qualcomm is betting that the answer is yes to all of it. Even if phone sales level off, the rest of the world is only just beginning to get connected and intelligent.
Well, next time you see some high-tech industrial gear, check the specs. You might just find a Dragon Wing in there.
You just might.
Thanks for doing this deep dive with us. We'll catch you on the next one.